discussing charts for trading. Now, it's no secret that online trading can be performed more efficiently if you possess the necessary tools. And a good place to start is with charts. Now, fundamental, technical, and quantitative analysis, there are a number of methods used by Forex traders and CFD traders to predict movements of currency pairs or other assets. Some traders focus on news, some on interest rates, some on economic variables, while others prefer to use charting tools and indicators to guide their trading decisions. Now, tonight, we're not here to learn about technical analysis because you have to understand and use charts first. But technically, or basically, anything and everything you do falls under the field of technical analysis. So we could actually just call technical analysis, this whole big scary field of technical analysis, we could just call it chart analysis. So no matter how you're trading, no matter what your strategies, no matter what your decision making is based on, you'll need to know how to read a chart. There's no escaping it. Luckily, we created this detailed webinar to get you started because you must crawl before you can walk. And charting is no different. You first need to have a good understanding of the basics before you can progress to the advanced stuff. So price charts are simply a graphical depiction of the current and historical prices. So imagine if I said to you, the pound is trading at 123.9, or the pound against the US dollar is trading at 123.9. It opened at 123.42, fell down to 123.02, went up to 123.97, then broke to 124.0, fell back down to 123.92, and it's trading now at 123.45. Can you repeat any of that to me? Can you tell me whether the pound was in an uptrend or a downtrend? No. Because our minds, our brains cannot keep all of those numbers and understand exactly what they mean. But if I were to take all those numbers and plot them on some type of a chart, even though I just take dots and put them, my brain and your brain can then visually take that in. So what's the old saying? A picture's worth 1,000 words. Now, there are many different display modes for charts. Most CFD traders jump in right away and they want to trade with candlesticks. Why? Because candlesticks are the buzzword of online trading. When I started trading 45 years ago, and even though candlesticks have been around since the 1900s, nobody used them because we were hand charting and they were complicated to draw by hand. But I'm not saying they're good or bad, but the basic chart that we've had around forever is a line chart. Now, a line chart doesn't tell us how much detail, but it can give us some understanding of where the market is heading or coming from. So what you see on your screen is a line chart for the euro US dollar in a 30-minute time frame. That means when you talk about time frame on a chart, that means every 30 minutes we will put a dot on this chart to represent the closing price at the end of that 30-minute period. And regardless of whether the price soared up and came down and went here and here, it's whatever it was at the end of that 30 minutes, we put a dot on the chart. We connect those dots with a line, and we have a line chart. Now, the line chart's been around forever, and it works well in certain things, but not for really trading because we need exact figures. We need to see what price is doing. So if you can go back with me 45 years ago, or just go back before there were computers that made all this stuff easy, a lot of people use line charts because it was all they had that wasn't a complex system. But the markets moved slower. There was less traders. There was no online trading. You were sitting in a broker's pit listening to the prices, and you get the prices through ticker tape, and it wasn't so quick in the movements. So a line chart could help. Today, virtually nobody uses a line chart. because it doesn't give us enough information. So a line chart is simply a string of prices that gives us a general price movement of an asset. Now, tonight, keep in mind that this line chart, this bar chart, and the candlestick are all the exact same asset at the exact same price at the exact same time. So we come over here to the line chart. The line chart's been around for a very, very long time. And again, before online trading, because even when we had computers and internet then, we didn't have all this advanced types of charting. Okay? The computers weren't programmed for it. Today, we can do almost everything and anything with our charts because the computers are all programmed to do all of this stuff. But I still trade from a line chart. I'm sorry, from a bar chart. Now, a bar chart tells you a lot more about what is happening in the market. Each one of these bars covers the open, the high, the low, and the close. For that, in this case, the 30-minute period. So at the beginning of the 30-minute period, we put a dash to the left. We then, at the close of that 30-minute period, put a dot to the right, a dash to the right. We put a dot at the highest price it ever reached and a dot at the lowest price it reached in that 30-minute period. And we put a bar connecting it all together. So this is a bar. But what a bar chart allows you to do is you can start seeing some common movement among price. You can start deciphering what is happening. Because here you see a hardcore, beautiful downtrend, and you don't see just a line chart going down. You can actually see all the opens and closes right down the line. You can see how much the assets move. Here, look at this here. We see all the highs and all the lows at exact same levels. Even though we had opens and closes in between, we can see this is the exact range that asset is going. Okay. We can also see how narrow the movement is right here. We can see how congested the market is, as opposed to a line chart that doesn't tell us any of this. The line chart, we just saw price come down, move sideways a little bit, and fall some more. We didn't see the congestion. We had generalities. Okay. So we have the open, the high, the low, and the close. But the fact is, no matter what type of charting you're using, you only have the open, the high, the low, and the close. And charts are historical prices. Okay, they are edged in stone. They can't change. They don't move around. The open for that period is the open forever for that period. Okay. It's not something that can be fudged or moved around. So whether you're looking at my charts, you're looking at somebody else's charts, you're looking at charts from some Chinese provider, and you're looking at some charts, and they're all going to be exactly the same. Okay, it is not up to any interpretation. So the bar chart is a very good charting method. From here, we go to the candlestick chart. One of the reasons online traders gravitate towards the candlestick chart is they think by seeing reds and greens, they can make decisions about the market. But the fact is, candlesticks have absolutely nothing to do with the reds and the greens. Okay. It has nothing to do with how many reds you're seeing and how many greens you're seeing. It has to do with what we call the shape and body and the pattern of the candlesticks. So as you can see here, this candlestick looks a lot different than that candlestick. Because the only thing a candlestick has is the open, the high, the low, and the close, identical to the bar chart. So what we do is at the open, instead of putting a dash, we put a line across. At the close, we put a line across. We put a dot at the highest point it made and a dot at the lowest point. We then connect the dots to the dashes and connect the dashes to the dashes, which forms the candlestick. Now, in the early days, ancient times, we use basically black and white candles. The reason being is we didn't have magic markers. We didn't have computers. We had crayons or the side of colored pencils. Well, for a trader who was charting by hand, because we didn't have computers doing this, it was easier to use hollow candles and black candles. So if it was a bearish period, they would take the side of their pencil and just fill in this box. So we'd have a black candle. If it was a bullish period, they would leave the candle empty. Now, a bearish and a bullish period is if the open was here and you stepped up from the open to the close, that's a bullish period. If in reverse, the open was here and the close was down here, and you stepped down from the open to the close, that is a bearish period. Today, that gives you a red candle or a green candle. Now, as you can see on the candlestick charts over here, we have some candles that look like this. We have other candlesticks that look like this one. We have other candlesticks that look like these. And we have candlesticks that have huge wicks going up and candlesticks that have balanced wicks up and down. We have candlesticks that are next to each other looking the opposite color or the same color. And candlesticks, like I said, are first about the body and the size of the wicks. So this is called the wick, okay, or the shadow. This is the body of the candle, and this is the lower wick. So you have an upper and lower wick. Now, when a candlestick has a normal size, and normal can't be defined, but when it's got a balanced body and whether it's a long candlestick or short candlestick, it is a candlestick that's telling you who's controlling the market at the moment. So in this case, the bears were controlling the market. In this case, the bulls were controlling the market. But when you get down to candlesticks like this that have no body, candlesticks that have small bodies, regardless of whether they're red and green, we call them indecision candles because it's telling you that nobody's controlling the market. When you see candlesticks that have long wicks going down and no body, that's telling you the bears tried to dominate the market, but they were unable to sustain, and the bulls pulled them back up where they are. So there's total indecision, but the bears most likely burned themselves out in that time frame. So, and then we take candles, and candles are all about the combination of the current candle, the next candle, and the candle preceding it. Okay, and we have all types of things. We have what we call bullish engulfing. We have tweezers. We have three black crows, three white soldiers. They're all interpretations of the pattern. Very few of these patterns have anything to do whether it's two reds or two greens. A lot of them, it doesn't matter. It's how big the bodies were. Okay. Some of them, it matters. We have something called a Marabuzu, which is about the second candle being fully contained in the body of the previous candle. And actually, Marabuzu in Japanese means pregnant. Then we have odd candles. I'm sorry. Yes. No. We have odd candles. I'm sorry. That's a harami. We have odd candles like the Marabuzu, which are candlesticks that have no wicks. The open was equal to the low, and the high was equal to the close, or vice versa. Okay. That tells you whichever way it was going, had full control of the market from the second that time period opened to the very edge of that time period. Well, if you had no lows, had a green candle, and it closed at the very top, what does that tell you what you could expect the next candle? You're expecting that next candle because the market had energy going up, and it should keep that energy for the next period. So you would expect the price to jump as soon as it opened, continuing upward. And we have reversal candles, and we have indecision candles, and we have continuation patterns. Okay. So candlesticks, if you just want to use your charting on candlesticks, because you can see trends, you can find support and resistance, you can see swing lows and swing highs easier with candlesticks, that's perfectly fine. They are, like I said, for online trading, they are the most popular charting method. But unfortunately, most people don't learn charting, don't learn candlestick patterns. A lot of people will memorize the 32 most well-known patterns, but they're also extremely hard to trade with. They're very hard to see. You can spend your whole day trying to pick out which ones were there. So it's one of the reasons these patterns in a fast-paced market in CFD trading is kind of difficult. But there are all strategies that involve when you see an indecision candle, and that's combined with a support and resistance level, that tells you something. But if you just want to use your candlesticks for your charting and seeing how things are moving, that's perfectly fine. But this candlestick is the exact same information as on this candlestick on the bar chart. Exactly the same. Okay. But again, candlesticks are extremely popular. You just have to make sure you do not let yourself get sucked in when you see lots of red, say, I'm going to trade that to go down. Okay. Because lots of red doesn't mean to sell. Lots of green doesn't necessarily mean to buy. So although bar charts and line charts were quite popular among Western traders, Japanese candlestick charts and additional patterns were introduced in the 1990s and have become the most, or seen a soar in their popularity. Most of the reason is because our new computerized charts will allow us to do virtually anything. So let's go over to a live chart and let's see these in action, all three charts. So I'm going to pop up my Euro US dollar chart. Let me get this indicator off the bottom here. And this is my standard teaching chart. Okay. This is the Euro US dollar in a 30-minute chart. Now, today's computerized charts, our HTML charts, allow us to do a billion things. For instance, if we were to take our candlesticks, we could decide we want to use orange and purple because we like orange and purple. There's actually some brokers that customize their candlesticks and use their company colors. It's fine. We use red and green because red and green, you automatically know whether that's up or down. But if you use pink and chartreuse, as long as you knew which one was the bullish and which one was the bearish, doesn't make a difference. But like I said, today's charting gives you, sometimes I say it's too much of a choice. But since we're talking about charting, one of the most important things you need to do is when you start using charts, whether it's on the ETX platform or using private charting service, you need to set them up correctly. You need to make sure you have your time zone set correctly. Okay, because you need to make sure that that fits your economics count, that you're not mistakenly have this set on, European time or British summertime when it's, and don't realize it. You need to make sure you have everything set up correctly. Okay. So now we've talked, and today's charts we can use and switch back and forth. Here we have the candlestick chart, and we decide we want to use the bar chart instead. We can click over and put the bar chart on there, or we can set up some of our analysis using the bar chart, and then we can flip back over and use the candlesticks. So those are the three types of charts. And as you can see, we have technically a lot of charts. But all of the other charts are variations. Like we have hollow candles and regular candles. They're all variations of these charts. So like an area chart is simply a line chart with one of the areas shaded in so you can see it more clearly. They're all variations. That's all that they are of each other. Now, these are the three different kinds of charts. Now, what you have to remember is the screen you're looking at when you're looking at your charts. Okay. adjust to how big your monitor is. The prices don't change, but if you're going from a 32-inch monitor to a laptop monitor, the condensed area you're looking at will be slightly different, but have the same exact information. But also the width of your charts, okay, also changes. It doesn't change any of the charts, but like for here, I'm looking at in this half-hour chart from 1800 today all the way back to the 10th at 06 a.m. Okay. So I'm seeing all of that in this price movement. The fact is, you just have to keep in mind, because you can pull your charts over and over and see all the historical data. Okay. So just remember, though, your charts are dynamic and you're only seeing what's available based on the, but you can adjust or set them up, or as long as you know that, you're perfectly fine. Just don't, something you don't want to forget. So you've got your chart set up, you got your candles on here, you got your asset you've chosen to look at. Now, we have to understand some things about charts. Today's charts, and all charts are, even when we do it by hand, we are talking about the Euro US dollar 30-minute chart. That means every 30 minutes, we're putting a candlestick on this chart with the close and the open. Okay. And it's not a flexible time period. You can't set it until you want the candlestick to go from 1247 to 12 to 1 7, whatever 30 minutes later. It's based on the clocks, based on the hour. You know, a 30-minute candle is 000 to 0030, 0030 to 0100. If it's a 15-minute candle, it still goes that way. You can't set. Now, you can change your time frame all the way up from 1-second charts to 1-month charts. So if we change this to a 1-month chart, what we're looking at is each one of these candles represents a 1-month movement of the asset. It gives us a historical view. A 1-month chart and the type of trading we're doing doesn't help us much, but we should always be aware of what an asset is doing. And charts help us do that, because when you're looking at a short-term half-hour chart, you're only seeing what that asset did over the last 2 days, through that whole period. So the asset could be in an uptrend at the moment, but over the last month, it was trending down, because then you can make a much better decision. Because if you say what we are is in the middle of a short uptrend, an overall downtrend. So you know the pressure is going down. Except today and yesterday, it was rallying up for some minute, but the pressure is weighing it down. You know, example, I mean, I guess I can use this example. You know, if you have a heavy-set man or woman, whichever it is, and they tell you they lost 5 kilos, okay, they did really well. But if you have a thin man or a thin woman and they tell you they lost 5 kilos, well, first of all, that's a worrisome factor, and it's probably a medical issue, and it's not such a good thing. So understanding where the pressure is coming from, or you put a heavy-set man on a diet and you put a thin person on a diet, and the heavy-set man in 30 days drops 10 kilos, and the thin man lost a half a kilo. Okay. Well, that would be expected, and it would have been just as easy, you know. So, but you need to understand it in the perspective of what it's doing. So a chart allows you to see historical movement and also change the time periods you're looking at. And this helps you to see the personality of the asset, as well as seeing a perspective of how it's been moving. So please keep that in mind. So this is what timeframes are. So like the shortest term time frame is like we might use for trading a 15-minute chart to determine our entry point. but we wouldn't use a 15-minute chart to determine our trade. We would use a longer term chart, a 1-hour chart, to determine if we're going to buy or sell an asset. The shorter term chart will help us pick the right price to get into the market. Okay. And then a longer term chart after that, by using a 1-hour chart, a 15-minute chart, and then a 4-hour chart. The 4-hour chart will give you an environmental overview of what is happening with that asset. Because if that asset has downward pressure but is rallied up, we want to be very careful about our decision making in the short term. But keep that, and we're keeping that in mind, but we're not making our decision based on that longer term time frame. Okay. Charting also allows us to put indicators and oscillators, technical analysis on our charts. So we can come up here and pick our indicators and drop them on our charts. So let's say we're going to take Bollinger Bands and drop that on our chart. We're also going to scroll down here to, let's go to RSI, Relative Strength Index, and drop that on our chart. So charts allow us to apply technical analysis. So we have price action on the charts. We can see where the price is moving. We can make decisions. Then our technical analysis, as is the interpreters. It's trying to interpret what price is telling you. And we can then build strategies. But if you notice, okay, if you watch, you'll see that these technical indicators don't change if I change it over to a bar chart. Except my bar disappeared. Oh, there it is. I change it to a bar chart and then go back to a candlestick chart. Doesn't care. And our indicators also adjust to the time frame in which we have it set. So this indicator for RSI and Bollinger Bands are all basing their calculations on the 1-hour price movement. If we change this chart to a 15-minute chart, we're going to see a lot of difference. Bollinger Bands looks different, so does our RSI calculations. So that's why I'm saying we would use a 15-minute chart to determine our entry points. But we wouldn't use a 15-minute chart to decide our trading decision. We would use a longer term chart. So if we went to a 1-hour chart, we would use that to say, okay, we're looking to go long. Now I've made my decision to go long. I need to figure out where I would enter, what price I'm willing to enter the market. And you would then do that from a shorter term and then make that decision at what price you're willing to enter the market. Now, charts also give us the ability to apply chart patterns. Now, what you're looking here is a triangle. Triangle is a well-known pattern in technical analysis, and there's a whole range of patterns, okay, that are well-known, respected, and defined. So here we can see we have ascending wedges, descending wedges, triple tops, bear flags, pennants, inverted head and shoulders, inverted cup and handle. We have expanding wedge and upright head and shoulders. There's only a handful of these chart patterns. Okay. Now, these chart patterns are very well defined. They're used by an abundance of traders because they're very reliable. And what these do is they tell us, or they explain the market psychology in an easy way that we can interpret. And these chart patterns repeat over and over and over, and they mostly give us correct information. So when we see a triangle developing on our chart, we can make certain determinations. Now, again, tonight's class isn't about chart patterns, it's about charts. So we're not going into the strategy and how to use it tonight because we have other classes for that. But this is the reason we need to master financial charts. Not just looking at a chart, but reading the chart, reading the price action, and using the tools that charts give us. Now, whether you're using a private charting service or you're using the charts on ETX, and we're going to go over and look at the charts in ETX in a minute. Okay. These, the layouts are different, what they're slightly called or slightly, but they all allow you to add technical indicators, drawing tools, and everything else. you know, every computer developer and every chart's different. But again, they're all using the same feeds and the same information. Okay. And the price, no matter whose chart you're looking at, no matter where you're getting the chart, is the price, and it's the same price everywhere. Now, I will make a comment to you about pricing. Okay. The price on a chart. Now, this has nothing to do with the price on our platforms. Okay. Price on no matter what platform you're using is the most up to the second price, because the brokers pay a huge amount of money for data feeds, because they have to have the most current data feeds to give you the best quotes possible. Okay. And almost all of these data feeds come from the direct same places. All stock prices come from the stock market that they're being traded on, and they come directly from. Gold comes directly from the exchanges. Copper comes directly from the copper. Okay, they're not one feed is different than another feed. Okay. It's what you're paying to get that feed and how fast that feed comes. Now, brokers, regulated brokers, have to give you best price scenario. So they have to have the most up to the second in order to give that. And that gives you a benefit, because the same data feeds that are feeding the platform for the trading are also feeding the charts on the broker's platform. Whereas here I'm using TradingView charts. Now, I have a subscription. I pay for TradingView. If you don't have a subscription, they offer the same thing, and it's free. But there's a slight delay on the free charts, because the data feeds are so expensive. They can't give that away, because also by how much data is being pulled at all times by so many people using a chart. And that's a huge amount of data. So whether you're using the charts here, the charts on investing.com, charts from Daily Forex, keep in mind charting services. And even if you're paying, sometimes when you're paying, $9.95 a month, they'll tell you some assets have slightly, and when we're talking about delayed feeds, it could be 5-second delay. Once it is delayed, the price of the feed drops tremendously. So a broker can't do this, especially a regulated broker, but a charting service, or like I said, when you're using Daily Forex, Forex Factory, you're using any of the charts online. Even when you're using, Bloomberg's or Wall Street Journal, every chart there is on a slightly delayed fee, because it's just too much money to waste for all those people looking at those charts, and you're not paying for them. So keep this in mind, that you should always be using the live charts on ETX. So I'm going to take you over to ETX, and I'm going to show you a little bit of information about the charts and adding indicators on ETX. Let me just erase all this stuff, and then we'll come back and talk a little bit more. So we're going to take a look on how to use our charts for on-chart trading, and then we're going to take a look at using the charts for putting technical indicators on the platform.